Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So, a while back, somebody asked on this channel if the banks are aware of what velocity banking is and if they know we're paying off debt this easily, right? And I don't know if like the people at the top know the name velocity banking, but I would say if I were in their shoes, they would probably really hate the strategy, right? And why do I talk about this is because there's actually proof out there that they lose a lot of money if people didn't carry any balances on their cards, right? Lose a lot of money. So if you take a look here at like the Built MasterCard, this is what I would call an accidental velocity banking card. If you don't know what velocity banking is, all it is you putting your entire paycheck into the credit card or line of credit, and then using your line of credit or your credit card to pay for things. That's all it is, right? So here we have a credit card that allows you to earn points on rent. Right, that's your credit card that allows you to earn points on rent, and you don't pay any fees on it. So think about this. Let's say I put my biggest expense, which is the rent, on the card, and then I put some other expenses like my gas, insurance, and food on the card. What's the likelihood I'm going to put my entire paycheck into the card? Most people would probably do that, right? So you've accidentally created a velocity banking card. And the reason why people would actually, or banks would know what's going on is because once they start to bleed a lot of money, they're probably going to figure out, oh my goodness, we should never create a card that incentivizes this ever again, right? And so Wells Fargo, which is the bank behind this card, you take a look here, they're actually losing $10 million per month, according to the Wall Street Journal in June 2024. And one of the things that they didn't understand is they miscalculated user behavior. So it says Wells Fargo is said to have miscalculated how users would behave with the card. The bank has told Bill that it needs more customers who carry balances and use the card for everyday purchases, right? So carrying balances, they make money through that by if obviously if you carry a balance, they charge you interest, right? That's one way. And another way that they make money is if you actually keep using the card, the merchants have to pay a fee for every time the card is used, which they call an interchange fee. But here's the thing: even if you use the card a lot, but you never paid any like interest or carried a balance, that would actually be bad for the bank because the bank makes money off of interest, right? And so they've created an accidental velocity banking card. And so yes, they may not be aware of the name velocity bank because that's just really just a marketing phrase or term, but they know when they're losing $10 million per month, right? They know, right? And so let's just figure out how we might get to this point of losing $10 million and go over what velocity banking is. So, what is velocity banking? So, this is like the simplest scenario of velocity banking. All it is a debt payoff strategy using a line of credit, aka your credit card in this case, as your main operating account. So we have the average American here, and then we have the velocity banker here, right? And so here, the average American, let's say they make $3,025 a month, and their expenses are $3,025 a month, and they got one credit card, and then we have food, gas, insurance, and in this case, we'll say rent as well lumped into one category, right? And so their credit card payment's $525. Okay. So what we're going to do is we're going to have the same income. We're definitely going to have zero savings, but we're going to make, and let me put, what did I do here? So let me do this. We're going to have something called cash flow, which is income minus expenses, but we're going to make sure our savings always stays at zero. So this is like the thing that people get shocked about is that this $525 actually becomes zero when you use it as your main operating account. And that's the whole point of velocity banking. So your main account is not your checking account. In fact, as soon as you get paid in your checking account, you're dumping into your line of credit. And actually, let me update this. This is 30%. And we'll say this is, I don't know, $14,000 limit. I don't know if anybody would offer you that at this salary. I don't know. But we're just going through the exercise, right? And so the last step is that you're going to put your entire paycheck into that line of credit, and then take your expenses out of that line of credit. So we'll say this is a $13,000 balance, right? Because this is the $13,000 balance credit card, and we put an entire money into the credit card, then this minimum payment doesn't matter anymore, right? And as long as we keep uh, using our credit card as our main operating account, we're putting everything in it, all of our money into it. It's much easier to pay it off, and that's essentially what the Built MasterCard does. Like literally incentivizes you to use your credit card as your main operating account because you have your biggest expense, which is rent, on the card, and then you could just put everything else on the card, and then somebody will naturally think, oh, I'm going to put my entire paycheck into it. That makes sense, right? You put your entire paycheck into the card. And then Wells Fargo, okay, they miscalculated user behavior because they just thought it's another credit card. And, people carry balances on credit cards and they don't use credit cards as their main operating account. And so let me just show you here with math how that would look like. Now, the numbers might be a little bit unrealistic because like I said, I don't know if there's a lender who would actually lend you a 14 grand credit card and you're making about $3,000 a month, right? But let's just go ahead and do it, and let's just do this. So the next month is the previous month's balance plus the previous month's interest. So next month's balance is the previous month's balance plus the previous month's interest minus our cash flow, which is $525. Okay, so we start off at 0 here, and this just kind of show an extreme example. And then let me go ahead and calculate the average daily balance, right? Let's look for the average function, average, and then we multiply it by the interest rate, 0.3, and then we divide by 12. Okay, so let's go ahead and do that, and then we'll copy and paste, and then just keep copy and pasting. So we start off at 0 cash flow, and then looks like things are getting a little bit better after about a year or so, and keep going and going like the Energizer Bunny. All right. And whoopsie. Let me go ahead and copy and paste this again. Whoopsie. All right. Copy and then paste. And then we see that in 38 months, which is about a little bit more than 3 years, this is all paid off. Now, is this the most ideal situation? Probably not, because you're literally at 0 savings and your income is exactly as the same as your expenses. But if you keep using your card as your main operating account and then get some rewards points, that might be good. But the thing is that we're focusing all of our money into paying off our debt, right? And if we're in a good financial position and then we get that card, charge rent on it, and then make it our main operating account, it's very unlikely that we're going to keep carrying balances assuming we had no debt before. And this is what Wells Fargo didn't understand, is they miscalculated user behavior. But well, I'm not saying how could you not know this, because again, it's hindsight is 2020, but but they've inadvertently created what we call the velocity banking credit card, meaning that you're using this as your main operating account. What's funny? I've had people like write comments about, like they're so angry because you can't pay rent with a credit card when I mentioned that you can. I was like, well, in what fantasy world? I'm like, ugh, and the funny thing is people understand the marketplace is always changing, right? So new products are being developed and offered. And unfortunately, Wells Fargo bet big on a product that did not suit their best interests, right? Like, who would have thought that an innocent credit card that allows you to pay rent would kind of be, I don't want to say their downfall, but make them lose $10 million a month. And, setting up a credit card is not like, you spending $100 and then that's it, right? They probably spent millions and millions of dollars developing the credit card, doing the legal work, financial, regulatory, and all that, and then the marketing and the advertising. So, in addition to the initial setup of the credit card, they are losing $10 million a month. And I think if I scroll down, it's probably there's all these Reddit posts, YouTube videos. $10 million a month, right? And that means $120 million a year just on this accidental velocity banking credit card. So when someone tells you, hey, velocity banking's a scam, I'll just say, yeah, maybe you're right, but tell that to Wells Fargo. You know, tell that to Wells Fargo. Anyways, all right. So that's it for today. So it must be a good day today because I'm making two velocity banking videos on a Saturday, and I probably need to leave and get some fresh air. That would probably help me. Just been sleeping a lot. All right. Well, that's it for today. Everybody have a great day, and we'll speak next time. Happy Festivus. No, I'm just kidding. I love Seinfeld, though. All right. Have a great day.